Joseph Aberson, Chief Investment Officer from Northvest. He's on the line with us today, and he's going to be moderating a panel, Investing Capital in the Time of COVID-19. With that, I would like to turn this panel over to Joseph. Joseph.
Sure. Can everyone hear me okay?
Yes.
Okay, wonderful. So I'll be your moderator for today's panel, Investing Capital in the Time of COVID-19. Just by way of background, I'm the Chief Investment Officer at Northvest Capital. I have a little over 25 years investment experience, but most of it is on the public side. So as a portfolio manager for TD Bank in Toronto, I was also an analyst for a long-short hedge fund in New York. And then I spent a little bit over the last 15 years at BCA Research as a strategist. So BCA is the leading provider of independent research to institutional investors for macro strategy. So turned 50, got bored, and have been working at Northvest ever since. Northvest is a leading private equity and venture capital firm in Montreal. So now let's move on to the panel. So the subject at hand, the impact of coronavirus on investing. COVID-19 has had an unprecedented shock on the global economy. Not since the Great Depression has there been such a rapid slowdown or as sharp a rebound. The only thing that has kept an enormous wave of bankruptcies at bay has been a massive government stimulus and central bank intervention. Jamie Dimon, just yesterday, told us that the worst of the coronavirus recession is yet to come. And he should know as the head of JP Morgan. Now that the second wave is clearly upon us, will real estate and distressed debt finally see their day of reckoning? If so, where are the opportunities and what areas are best avoided? We rely on our esteemed panel of Louise Pacheco from Brainvest, Josh Koplowitz of Tyre Street Partners, Robert Lorenzo from Eden Rock Capital, and Peter Foran of Pine Tree to help us navigate this potential minefield. Before beginning, maybe each of you can tell us a little bit about yourself. Try and keep it to less than a minute, as well as your firm. Let's start with Louise.
Hi, good afternoon, everyone. I'm Luis Pacheco. I'm portfolio manager for Brainvest Wealth Management. We are a multifamily office with around $2 billion in assets under management. We have offices in Geneva, Switzerland, here in Miami, and in Brazil, in São Paulo and Rio. And our clients invest from everything from fixed income and equities, the liquid stuff, to alternative investments such as real estate in Europe, here in the US, music rights, airplane leasing, life settlement funds. So our clients are very well diversified in their portfolios. We're doing alternative investments for almost a decade now since we started in Europe, and interest there are low since 2010 pretty much. Thank you.
Okay, so let's pass it on to Peter.
Hi, my name is Peter Foran. I'm Executive Vice President at Pine Tree. Pine Tree is a JV partner, GP, and vertically integrated operator of retail real estate throughout the United States. Vertically integrated meaning we have property management, leasing, asset management, portfolio management all in-house. It's about $3 billion in assets under management. Again, open air centers, think grocery anchored power centers, things like that.
Okay, now you, Josh.
Hi, I'm Josh Koplowitz from Thayer Street Partners. We're a New York City-based private equity fund. We focus on financial services and business service opportunities that really fall below the radar screen of traditional PE funds. Most of our team has come from larger investment firms like Goldman Sachs, Fortress, and Blackstone that are applying our skill set and knowledge to the lower middle market, which has historically while it's historically outperformed larger funds, gets little attention. And we think that in particular, there's a tremendous amount of opportunity around real estate services, items that are purchased by a property manager, rent collection services, property management, elevator maintenance, that have the same level of underwritability, stickiness as real estate, but in some cases, they're less volatile. That's where we're spending our time currently. Have done a couple $100 million of equity checks, and in the time of COVID, we expect we'll deploy $100 to $200 million of capital.
That's fantastic. Thank you very much. On to Robert. Robert, are you there? Okay, so we'll
I'm
come
here.
back to that. Robert, are you there?
Yes, I'm here.
Okay, go ahead.
I'm Bob Lorenzo. I'm Senior Managing Director at Eden Rock Capital. We are a middle market private equity firm based in New York with a concentration in real estate, mostly non-dollar European-based real estate investments. We've been in this market for about 10 years since at around the time of the collapse in the 2008 collapse in the markets. We focus mostly on non-performing loans, refinancings, as well as underlying real estate purchases.
Okay, that sounds fantastic, and that's actually a great place to start because during the crisis, I actually did a very in-depth report on the various European countries for a leading real estate firm out of London. So I'm very interested in your view, Bob, comparing that crisis and the opportunities that you could see then, either in loans or underlying real estate, compared to this crisis.
There's a big difference between 2008 and now. When you look back at 2008 with the financial crisis, it created a lot of panic and opportunities within the market, but it was not a sovereign issue. It was a market issue that could be overcome. Basically, it was a classic real estate bubble that burst, and it left enormous opportunities, particularly in areas like Ireland, where you had lots of properties which were coming on the market for less than the cost of the bricks and mortar. They've seen an incredible turnaround in the last 9 years in that market coming back, and a lot of it was just the fact of there just wasn't enough supply to meet the new demand as their market pivoted. Looking at it in today's market, this is a lot wider and deeper than we've seen in the past. This has really touched upon every sector of the market, from manufacturing to financial services to healthcare and et cetera. I mean, there's very little areas in the market that have remained untouched. From the real estate perspective, you will see a plethora of buildings and opportunities come up, whether it's on the non-performing loan side, asset sales, asset refinancing, et cetera, which will mirror, if not be exponentially greater than what you saw in 2008 to 2012. The big difference being we're beginning to see a seismic shift in the usage of those properties. It's not that you've got large commercial spaces or large residential spaces that are dealing with the effect of a recession, and eventually the markets come back and those spaces will be taken up, and it's your classic 7-year real estate cycle. What you're seeing now, or at least what we're perceiving now, particularly in Europe, is a fundamental change, call it this generation's 9/11 moment, where the markets are changing dramatically, where working from home is no longer frowned upon, it's encouraged. And firms are realizing that they may only be 80 or 85% as effective by having people work from home. The difference is they're saving 30 or 40% on not having to rent that space to house that person. So net, they actually are doing better. So, we are getting concerned that the commercial real estate market is in for a major movement because there will be tons of space coming available with very little at least in the short term, of using up that overhang of availability. And it will require a major pivot on the side of the real estate investors, as well as a rethinking of what do you do with those spaces.
Okay, that's wonderful, Bob. And I think that really clarifies some of the differences that we really saw something that was a financial crisis in 2008. This is much wider, and your belief is that there will be very structural and permanent changes in the ways that people live their lives. It's quite interesting looking at the other side of the pond. Maybe what we can do is have Josh speak to the view within the US as to the differences between 2008, as well as whether he sees any structural changes in terms of any of the major real estate classes.
Sure. So we focus primarily, we historically are focusing more on the service side, and whereas 2008 was driven by liquidity, what we're observing is we actually think there may be change in certain types of businesses and certain asset classes based on change of behavior, and that change of behavior may not just be, well, people are sheltering in place, but it may be permanent. And this may be accelerating themes around how people work, how people live, that we're beginning to build, but would have not have unfolded nearly as quickly. And so the way we've decided to invest in light of that is to find areas of the value chain that are either unmoving or are going to be required on an increasing basis, regardless of how people operate in an office, or whether they move out of big cities or not. So services that fulfill a state-driven regulatory requirement, and almost all states have increased their regulations around how properties are managed, how C of Os are enforced, making sure an elevator is maintained, making sure there's clean air, requiring certain treatment of client payments. And so we've approached this by finding companies that are going to enable property managers and property owners to manage their properties in a compliant way, and perhaps do that using some technology so it doesn't require as much face-to-face interaction.
Can you give a quick example of one of the services that you're quite bullish on that really just is not getting impacted at all by coronavirus or recession or potential of banking issues?
Yeah, I'll give you two. So one is electronic rent collection. So we've invested heavily along this theme. A lot of residential rent collection still today takes place by paper check. More forward-thinking landlords and property managers have offered ACH or credit card-based payments, but this is not necessarily that easy. A lot of cities and states have very tenant-friendly but arduous regulations around how rent or maintenance fees can be paid. So investing in a solution, a software solution that integrates with a bank and the key property management and accounting systems that allow a landlord or owner to collect rent in a compliant manner, but do it electronically, that's a system and a tool that is only going to increase in usage. And I think that continued adoption of that only accelerates today, right? If you look at the number of people that didn't use Amazon a year ago versus the percentage of the population that is highly active on e-commerce today, there's a massive behavioral shift, and that's going to permeate into how people interact with places they live and places they work. Another example is regulations around safety. Regulations around safety need to exist regardless of whether you have new construction or whether buildings are 100% occupied or 1% occupied. If you are not fulfilling that regulation, you lose your C of O. And as states are more strapped for tax income, they, in many cases, we have heard that they're going to enforce certain regulation more rigorously. So a service that ensures that your elevator is properly maintained is going to continue to be needed, kind of regardless of how people change or stick with old behaviors.
That's very, very insightful and interesting. I'm going to make a contrarian argument here. It's very well known that people are impacted by recency bias. So in other words, they take the most recent event and then extrapolate. And so I think in places that are not suffering from a second wave, like most of Europe, so far in Canada, so far in some of the northern states that were hit earlier, that you can make the argument that the amount of structural change is going to be a lot less than people think, that human nature just doesn't change that much. So in that sense, you know, maybe things are overdone and there are some bargains out there. I was just wondering, Louise, would you see anything like that where markets have maybe overreacted or some of the private investments have shut down? I'm not sure how close you are to the pulse in Brazil, which has certainly had its fair share of problems, but you know, maybe there's some issues there that things are not overdone. So would you agree with that view, Louise, that maybe things are overdone and we're going to look back in a couple years and everybody's going to be flying and people will be using hotels and this will be the opportunity of a lifetime? Or would you agree with some of the other panelists that we will see some of these more permanent structural changes? And how would you differentiate between the things that are structural and temporary?
I think the answer lies in the middle, as usually. I think hotels will come back, but will be different from they were before, and everything else will be different, but will not be as totally different as people think, and will not be totally the way they were before. So probably it will be something in the middle. And we just have to keep following, like we allocate capital, so we invest in funds like Josh's fund or Robert's. So we try to find good managers that they are specialized in a niche to invest our clients' money. But what we saw during this crisis is everybody saying there's opportunities of a lifetime, trying to get more capital. But clients were more focused on the liquid side of their portfolio during the crisis, because that was the action was happening there, and they were seeing that their portfolios deteriorating on the liquid part. So they were more worried about that part. And I think now that the markets are calmer on the liquid side, at least, we might see more money flowing to the alternative part.
Okay, and Peter, you know, you are focused on retail. So I think you almost definitionally have to be a contrarian. What would be your thoughts in terms of, you know, kind of the structural change versus something that provides a real opportunity? And how does that play into your space?
I think retail is the darling of investment right now, and so it's in my mind it's a real good time to be in open air retail centers, not so much enclosed malls. I think structurally, what we see is consumer behavior, even throughout COVID, has remained unchanged. People still want to get haircuts. They still like to go to a store. They haven't been able to do that, and the experience is now much different. If anything, COVID has accelerated the businesses in retail that maybe weren't very good to begin with and weren't able to adapt their business models to omni-channel distribution. We saw Best Buy emerge a couple of years ago by really not trying to stave off internet sales, but embrace it and make it part of their in-store sales channel. And they have seen sales obviously coming out of their prior issues is one tenant I would specifically mention. And then again, being contrarian, we see capital flowing to grocery anchored centers or investments that are counter-cyclical. When times get tough, people buy more groceries. We certainly saw that with the run on toilet paper and paper towels and Lysol products, and grocers doing sales, every day was like the week of holiday season. So yeah, I do think retail is contrarian. The word that I would use is innovation is even more important now than ever in our business.
So, Peter, just on a follow-up to that, our fund is very opportunistic, and we tend to have some deep thinking LPs that can take short-term volatility. And so within retail, we've not been so much focused on buying the deep values, which we love, but deep value plus transformation of the asset into something that has a high value. So if you were buying some of these distressed retail assets, and there's a lot of them, what would you be looking to transform those assets into outside of retail? This may not be your core competence, but maybe think outside the box.
No, I think we do a lot of this, and
Okay.
we have this discussion with a lot of individuals, investors, and then potential investors as well as we look at assets we have. There will always be a place for retail, and if you're at the main intersection in a market, that will forever be a retail asset. That's where the retailers want to be, and that's where store sales are generated. Once you get beyond that, we see a lot of movement towards storage or last mile distribution.
Okay.
And envision a big box anchor where you cut the space in half, not north to south, but horizontally, and you repurpose the back for last mile distribution, maybe for the tenant who has a store in the front half. Ghost kitchens is another retail use that we see coming online, where people don't need a storefront or a dining room. They're just a kitchen in the back so they can distribute the food. And then there's always multifamily. We don't see a lot of transition to industrial. It just doesn't fit with the community, but definitely multifamily and senior housing.
Okay. Very, very interesting, because we're seeing, especially if you can buy them on the debt market, some of those properties can be bought for pennies, on the dollar. And I should say, in terms of the contrarian view that I brought up, it really it depends. The things that I think, the trends that will continue would be the ones that were already in place, such as working from home, and they'll accelerate. Whereas the ones that weren't in place in a single wave, I think are going to reverse. So on that, let's get to the bottom line. I'll go around the panel, and a simple question with a simple answer. What is your single favorite investment idea right now, and why? So let's begin with Luis.
All right. The one that I like most right now, and because of everything happening, is life settlement space, because pretty much it's uncorrelated to every market, just depending on lifespan of people and if they buy insurance or not. So I really like it, and I think it's a good asset to have in the portfolio, in the diversified portfolio.
But Luis, Stocks are up 50% in 3 months. Why don't you want something correlated?
Well, but they're up 30% in 3 months, but they are 0 in 6 months. So we have to think long term, and I think long term it's good to have a pocket in your portfolio that is uncorrelated to everything else.
Absolutely fair enough. Peter, your single favorite idea right now?
Yeah, so I'm a retail guy at heart, and I think that retail is, the pendulum is swinging, and there's overreactions to that word retail, which has become a 4-letter word. And I think you can pick off some real good opportunities with long-term credit leases where retailers meet the market at, below market rents and not a lot of risk.
Okay. And you, Josh, your single best idea and why?
So our best idea is aggregating assets operated by mom and pops that may want to call it quits or find liquidity in this market.
Yeah.
And within that, the area we're most excited right now is around marina storage. We think that in the last 2 downturns, usage and demand for boat storage stayed stable. In the wake of COVID, that's only increasing, and the opportunity to buy and aggregate marina storage operations that have historically been undermanaged and undermonetized in a way that one can consolidate is really interesting, because that asset class has current cash yield. But if you can aggregate a really diverse portfolio, you can get a lot of synergies in terms of management and back office, and on a portfolio level, these assets can be purchased by real estate investment trusts. So there's tremendous arbitrage, but also very low volatility.
Are there any, usually when I think of consolidation strategy, I'm thinking about either something with economies of scale or something where you can apply a new technology that's much better than the current. I can understand how there's not professional management, but to really move the needle, I think you need one of those 2 things. Do you see?
There are, yeah.
Market?
So there are economies of scale. They're more on the expense side, but management. There are a lot of cost centers and administrative items that can be centralized.
Okay.
If you are have multiple locations, you can materially consolidate back office, client services, and leasing. The other thing that you can do is there are other material cost centers in this business, like insurance, and client interaction. Insurance can be reduced if you have bulk and scale. And there's a lot of interesting technology out there that can help people better optimize the space and the layout of a marina, and also improve the customer experience in terms of.
Okay. Those are certainly valid points. And last but not least, Bob, best idea and why?
I would say best idea is investments in digital health. Right now, we have seen healthcare get pushed to the forefront much more so than it has been in years. You're going to see, as I said before, with telecommuting, you're going to see things in terms of telehealth, online screenings, anything that can be done digitally with use of artificial intelligence, etc. The digital health area has raised over $62 billion in new capital over the last 3 months. So I think that you have to, as the other gentleman has all said, be concentrating on alternative ideas. Yes, the market is up 50%, but it was down probably 60 at the low. So when you look at it, I have been around long enough to know that one of the tenets of a bear market is excessive volatility, which is what we've been seeing. The equity market, although it presents short-term advantages and opportunities, long-term now, it's, unless you were sitting in cash on March 17th, you are just about breaking even. You need to look outside. Digital is the way to go. Any type of tele is the way to go, and anything in artificial intelligence.
That's very interesting. I agree wholeheartedly, and I wrote a piece in 2016, basically arguing for that. Also arguing where you're better off with not so cyclical things at that stage. But it's quite broad. Are you looking at private companies or public companies? And within that, can you give one or two specific technologies to benefit from either digitization or telehealth?
Right now, I would say private is the way to go. I mean, there are public-private partnerships that are out there that are being heavily funded by the government, but that is something that can be more or less fall into the flavor of the day category and fall out of favor very quickly. What we're looking at are opportunities that have a big piece in artificial intelligence, i.e. diagnostics, radiology, dermatology, and orthopedics are ones where artificial intelligence can do a tremendous job in terms of helping to increase the accuracy of the diagnostic as well as planning out the treatment schedule.
Okay. We are actually on the buy side, but what I can tell you this is Montreal is a leader in AI, and there are some great companies here focused on exactly that space and are just vastly better at what they do than physical doctors. And if you do early stage, there's many opportunities. So kind of just very quickly, how has COVID changed the way that you think about the world? So we talked about very specific opportunities. Now we're taking a step back. How has it changed your methodology? How has it changed your approach? And rather than the next 3 or 12 months, if we look over the next 3 or 5 years, or even 10 years, what are the major themes that you're using to navigate through this post-COVID world? And so just to be fair, we're going to switch up the order, and we're going to start with you, Bob.
Okay. Some of the
How do you think about the world and the major themes?
Looking at a 5 to 10 year time horizon, I think that we are at a pivotal step in society where things are becoming much more apparent to individuals, and also you're realizing that the risks that are out there are actually going to be greater. I don't think this is going to be the last pandemic, and certainly something else will rear its head if it doesn't. So looking at this, we have to think about what is society as a whole going to look like in terms. I think that people are going to be valuing time more. I think that you're going to be seeing, at least from the real estate side, we're looking at more investments in the residential areas, because people will be looking for homes and apartments with extra space to do work from, or at least spend a day or two there. We're looking at the demographics of the way people do their shopping, from the bricks and mortar to more online and ease of use. It all gets down to experiences. Do you enjoy going to the mall, or would you rather spend it at poolside or with your children? And that's something we're coming to grips with. The other thing is really embracing what I would call believable technologies, things like artificial intelligence, things like digitization, different than when you looked at cyber currencies years ago, where people didn't ultimately understand it, but invested in it because it was there and it was big and it was loud. These are other types of technologies which the average layperson or the average non-technician can understand. And how do you implement that into current strategies? So we are really rethinking our investment focus, saying, where will the opportunities lie that increase quality of life? And that can go from real estate to medicine to shopping to food and beverage. There are a lot of areas that we're beginning to explore that. And we think that's going to be the change going forward.
I agree with all of your themes. I don't agree with your assumption. I'd be willing to bet anyone that there won't be another pandemic in the next 5 years. If you look at Bill and Melinda Gates Foundation, that was warning us about this before it happened, they were looking for a 5% odds of a pandemic over the next, I think it was 5 or 10 years. now that we've had one, I think the probability says that it's unlikely, especially now that all policymakers will be very focused on the prevention. That being said, on to you, Josh. How has this changed the way that you think about the world? Maybe not at all. And what are your major themes for 3 to 5 years or 5 to 10 years?
So it hasn't changed, not to give a boring answer, but it hasn't changed the way we've thought about the world all that much. For a long time, we've been really focused on picking spots in the market that were inherently less volatile and probably had less exposure to material changes in the economy or changes in the capital markets in the short run. So we've been betting on longer term themes. Those themes have been around either consolidation plays, around very fragmented small businesses and aggregating those needed, necessary businesses into more established institutional players. And then the second theme, which feels quite obvious as we sit here today, but it's actually been fruitful in generating a lot of investment ideas, has been the migration away from the reliance on people and paper to maintain regulatory requirements. And so thinking through services that either use the internet, that use cloud software, that use data to enable a user, a property manager, a resident to be compliant and go about their daily life with limited exposure to people, believe it or not. So this is, after a number of years of seeming quite boring, the adjustments in the market today actually have created a really unique time in our business.
Yeah, so Josh, it seems like you're a real deep thinker. I'm just wondering, because you play in the area as well, what do you think about consolidation of our industry? That there was just so many new firms and so much capital going into private equity and venture capital over the last 10 years. Now it's tougher to get financing. We're going to get less leverage on deals, and there's clear economies of scale. What are your thoughts?
It's a great question, and not one that I've thought about, a great deal. But I think it would make sense that if we do have, if shelter in place and quarantining and all these restrictions continue for another several quarters, that I do think it's going to lead to a great deal of consolidation, particularly I think you have one bucket of capital, which are very institutional firms, private equity firms, and they're the new banks. You have another bucket of GPs that are really specialists. And that probably includes most of the people that are on this call. And then I think you have some kind of a group that's in the middle that are generalists that don't have the scale of the Blackstones and KKRs of the world, and maybe one notch down. And I think you're going to see some of those folks consolidate or partner or merge in with some of their biggest capital providers. So maybe they get acquired by an insurance company or a pension, or as a team that all of a sudden invests on behalf of a family office or an RIA, because private equity itself is more prevalent than ever before. And in some cases is more commoditized, particularly if you're not focused. So that would be my guess.
Okay, now we're getting a little bit short on time, and I have some additional questions I want to ask. So Peter and Louise, I'm going to limit you to 1 minute. I know it's tough because you're talking about 10 years, but Peter, at least you're in a narrow area. Has it changed your long-term thinking, and what are your big longer-term themes?
No, it hasn't changed my long-term thinking on retail real estate as a part of a diverse investment portfolio. And I would actually echo some of Josh's comments. What I think has changed is the need for active asset management, whether you're an investment advisor, a real estate advisor, a tenant. You can't just sit back and collect money anymore. You can't just put product on the shelves. People aren't going to buy it just because you put it out. You have to be engaged with all facets of whatever your business is. So for us, it's retail real estate, actively asset managing those. I think the need for that is needed more, not, now more than ever before, and will continue.
Okay, and Louise, again, under a minute.
Yeah, so as an asset allocation standpoint, I don't think we change our views that much. Just like doing tax.
Whoever has the dog on the line, be careful, because I have a cat, and you may just get a whole bunch of animal noises.
Not me. So in terms of asset allocation and the liquid part, it didn't change much, the overall allocation. We're increasing risk and fixed income. But on the alternative side, we're looking more, for example, senior living here in the US,
Okay,
trying to find something on the healthcare space,
okay.
and the sort of stuff. But on the liquid part, I don't think our method and our location changed because of COVID.
Okay, so that's great. I think, like any good chess player, we can't just think one move ahead. We have to think a couple ahead. And so it seems likely that there will be a vaccine, but likely is 55%. And we'll already be in the fall season where hospitals are full from traditional flu. So let's say we do get the vaccine in January. What do you think is the major impact on investment from that? Let's start with you, Peter.
I think there's still going to be a lot of people hitting the pause button
Okay.
for fear that maybe COVID morphs into something else. Maybe
Okay.
there's another pandemic that will come out there. I do think over the long run, though, I expect things to return back to kind of pre-COVID levels.
Okay. And Louise, your thoughts on the impact of a vaccine if it comes in January?
I think the market's already pricing a vaccine soon, the next like 6-12 months, and speedy recovery of the economy also, like a V-shaped recovery.
Yep.
I think the market's priced that already. So we
Okay.
have to follow that up and see if that happens or not. If it happens, we should not see a huge gain, but if it doesn't happen, the markets could draw down by a lot. So we'll see.
So you want to be in uncorrelated assets like the one you mentioned that generate alpha, right?
Yes, yeah, you have to do a portfolio that's kind of uncorrelated to the markets, but still have some equity exposure, some fixed income exposure. So if everything goes according to everyone's expecting, you profit from that also.
Well, I've been investing for 30 years and I guarantee you it never goes the way everyone's expecting.
Yeah, you're right. Never go.
So on to you, Josh. What would be your answer to that question? Post-vaccine.
I think it's going to be, harder for me to opine on real estate assets themselves, but I think as it relates to services, I think it's the continuation on the same thing, right?
No big
Because
change.
I think new ways of living and operating and managing are just going to be accelerated, and will continue on that same trend line post-COVID.
Okay, and last but not least, Bob, impact of the vaccine?
I think that the country and the world will breathe a collective sigh of relief that we've got it. But although I do think that life as we know it, or as we know it pre-COVID, will never be the same. I think people will still continue to worry about possible future outbreaks, the way they handle things, how they approach investing, how they approach their lives in general. So I think that it will give people a little bit of breathing room, but the world as we know it will change. It may get very close to what we had, but it will never be the same. And I think that it's going to stir up a lot of collective thinking. And from a positive standpoint, I think things will get better. But again, a lot more changes, and we'll have a shadow of what we had before, but not exactly.
Okay. So the last question I'm going to ask before opening up to some of the online questions is one of differentiation. So if we look at the world, the coronavirus is not a single thematic episode. So one thing that I've been playing for the last 2 months is that Asia dealt with coronavirus, very well. And because they had SARS, that the risk of a second flare-up was quite limited. And so now we see a world where I believe that's still true, but getting discounted in Asian markets. The US, some states have had a massive second wave. And keep in mind, if you add Florida, California, and Texas GDP, it's the second biggest economy in the world next to China, bigger than any European country. So you have some places with a second wave, some places in the US where it hasn't happened. It looks like Europe, not much of a problem, and I'm not worried at all about Asia. And then if you compare emerging markets, as Bill and Melinda Gates Foundation predicted, it's a disaster. And developed markets, not so bad. So if you were to differentiate either by geography or sector, what would be the long and what would be the short? What do you like and what do you avoid? Let's start with you, Bob. Based on
Long and short.
coronavirus.
Based on coronavirus, I do think that there will still be opportunities in many of the sectors that we hold near and dear to our heart, commercial real estate, residential real estate. We're now pivoting somewhat to the technology side. We have been for the last 2 to 3 years. So I think that we will continue our focus there, and any types of technologies that do enhance the other sectors that we're involved in. For example, there is a fund that we have been working with this last year that does real estate technology, believe it or not. That means, as Josh was saying, electronic payments, and has to do with parking and stuff. But we are going to push us.
Bob?
Yes.
Oh,
Hello?
sorry, you cut out. Do you have more to say?
Hello?
Bob, do you have more?
Did you hear? I just, I was just speaking. Did it not pick up?
It just cut out for about 10 seconds. Maybe because we're running low on time, just do a quick wrap up. Basically we heard that you like commercial and residential real estate tech, electronic payments. Was there anything we missed?
No, that was you got it all. You got it all. Anything that touches technology in any of your current sectors is where one should be strategic.
What would you avoid, like with a 10-foot pole? It's toxic. You wouldn't go anywhere near it.
I would say I would be staying away from airlines. I would be staying away from commercial. I would be staying away from retail, and I would be staying away from small commercial. That's just, not with a 10-foot pole, maybe 5-foot, but those are areas that we would be taking a break from.
So Peter, you're quite bullish on retail. What's your counter to Bob? Why is he wrong?
Well, I don't know that Bob is wrong. I think the key is that retail can't be put into one bucket.
Okay.
And there's different retails. What I would be staying away from with a 10-foot pole is an enclosed mall that's the fifth of five in some suburb of a major city with J.C. Penney and Sears and Von Maur as the anchors. Those are very scary to me as an investor.
Okay.
What I like, and I can shed a little light from the ground level here, is it was actually the national tenants who we had the hardest time collecting rents from through this COVID crisis. The small mom and pop shops who you don't invest a lot of capital to re-tenant those spaces. Some of it's, I think, pride of ownership. They don't default on their obligations, whether that's their mortgage, their lease, whatever it is. This is their livelihood that they're running. It's not just a job with a financial analyst running a present value on should I make rent payments or not. This is their livelihood and their business. And so for those folks, the mom and pops operating our tenants, they continued to pay where they could. Where they didn't, there was assistance, and the number of rent relief requests were the lowest from that group
Okay.
in our entire portfolio.
And Louise, your differentiation either by geography or by sector, the areas you really like and the areas that you would very much stay away from.
And the last two questions, they seem so simple yet so hard to answer.
Of course.
Yeah. In terms of equities, we prefer like US stocks instead of European stocks, just because we think US companies are more prepared to what's going on. In Europe's more like everything's harder there to happen.
Mm-hmm.
But in the alternative asset space, we like, as they mentioned, retail is, you don't have to put everything in one pocket. So I don't think we are close to any kind of investment. We just prefer things that we see that won't have any impact in the future, like senior housing and triple net healthcare, maybe.
Okay.
And we're trying to avoid offices right now because we're not sure what's the future for office space is going to be.
Okay, I'm just going to challenge you on your US versus Europe. The US has outperformed Europe for more than a decade now. It's gone from 45% of global capitalization to 65%. Usually what happens is US outperformance versus Europe goes every other decade, and you can go back to the 1970s. It flips decade after decade. And the relative valuation between the two is maybe 3 sigma. So, okay, I understand the banks, but for non-banks, the European companies are global. I mean, Siemens just has its head office in Germany. It has as much US sales as GE does.
Mm-hmm.
So,
likewise, American
what
companies
do you
are
think
global.
the risk to that view is?
Yeah, I think you're right. The biggest companies in Europe and US are global companies. Apple is a global company. Microsoft is a global company. But on the other side of the scale, smaller companies, I think the way things work in the US are more dynamic than in Europe. So it's faster for someone here to lay off people and adapt their business to this new environment than it is in Europe. And also Europe has different countries. The European Union is not totally unified, so things usually take more time there to happen. But still, we prefer like American companies, the biggest ones that are on the forefront now. So global companies, basically.
Certainly the US has better technology companies than Europe.
Yeah.
Because for the most part, Europe doesn't have technology companies. On to you, Josh. By differentiation, by geography, by sector, that can be within the US because you do private equity, or globally, whatever you think is best. What do you really like and what do you hate?
I really like from a sector perspective, probably a bit of repeat, but I like technology enabled services, and I like services that have a regulatory bent to it, fulfillment of a regulatory need. From a sector perspective, I actually, from a geography perspective, I like low income tax or no income tax states. I think that
Okay.
there's going to be a continued flight, at least in the short to medium term, out of cities with higher taxes. There's going to be a shortfall in municipal and state budgets, and you're going to see a continued migration of folks, at least on the East Coast, to places like Florida and maybe even Tennessee.
Okay. So that's fantastic. We're going to quickly run through the four of you. We only have 2 minutes left. So I'm going to be very tight on the time. Did we miss anything? So Louise, 30 seconds. Anything that we missed that you'd like to put out there?
No, I think the panel was very fun to be part of. You made
Nice.
several good questions. So thank you.
Nice. How about you, Peter? Anything that you want to say or forever hold your peace?
No, I think this was good. The dialogue was great. And if someone does have questions after this, happy to chat whenever available.
And Josh, how about you?
Really enjoyed it. Similarly, we have happy to answer any follow-up questions. And just as an aside, our fund or our business invests through commingled funds, but we also sometimes do special funds just based on a specific investment idea or a theme. And some of them follow some of the points that we covered in this panel. So happy to follow up with any folks that have interest in that.
Josh, we're gonna talk offline, but by phone, because Canadians aren't allowed to go to America right now. Last but not least, Bob, you have the final comments of the hour, so make it worthwhile.
I think it was very, very informative. I did enjoy the back and forth. I liked, Joe, the way you challenged the ideas. I think that if anybody leaves with this conference, what you have to remember is that you have to be flexible, you have to be quick, and you have to have some foresight. This is not our father's investment world anymore, so we have to be very nimble and to be able to navigate these waters going forward.
Thank you so much. Our fund has a lot of dry powder, so if anyone has good ideas, feel free to flip me an email and I will pass it back to you, Michael, because we're at 2:30 on the dot.
Joseph, thank you very much. Thank you to all the panelists, the speakers, for sharing your insight into what's going on today. And we appreciate you guys sharing, frankly, some of the things that challenges each of our investment beliefs.